Okay, so let's unpack this. We are diving into a really fascinating case study in FinTech disruption, KOHO.
Hmm.
This company didn't just try to be a slightly better bank, they asked a totally different question, you know? What if everyday Canadians just deserved more transparent value instead of constantly being penalized?
It's the perfect mission for the market they were walking into. So
Mm.
KOHO starts in 2014 with founder Daniel Eberhard. And our mission today is really to analyze how they navigated Canada's, well, notoriously conservative and powerful banking system.
Right.
This isn't just another startup story. It's almost a blueprint for disrupting an oligopoly.
That context is so important. Canada's financial world is just, it's dominated by the big five. It's an incredibly tough place for real innovation to take root.
It is. It's nothing like the UK or the US, where you had challenger banks just emerging and scaling aggressively.
So what made it for difficult?
Well, you had these really high regulatory barriers, a very conservative risk culture, and you had consumers who, I mean, even though they were unhappy with fees, they almost never switched banks.
Inertia.
Exactly. And that created this huge gap. KOHO just laser focused on that gap, realizing that the real engine for change was this simmering frustration over hidden fees.
Okay, so that focus on fees, that's their entry point. KOHO comes to market with something that seems really simple, right? A prepaid Visa card, a nice mobile app.
Deceptively simple.
Right, but we need to look under the hood here because they completely flipped the traditional banking revenue model upside down.
They did. They moved from what you could call an adversarial model to an alignment model. I mean, think about the old structure.
The legacy banks.
The legacy banks.
Yeah.
They rely so heavily on penalty revenue, overdraft fees, NSF charges, hidden monthly fees. It's a system that's literally designed to make a profit when the customer makes a mistake.
So if KOHO's basic product is essentially fee-free, how are they actually making any money?
Let's get into the mechanics.
That's the key. It's the interchange fee.
Interchange.
Exactly. Every single time you swipe your card, the merchant pays a tiny fee to the card network and the bank that issued the card. That's interchange. And because KOHO has, dramatically lower operating costs than a brick-and-mortar bank,
No branches.
no branches, that little sliver of revenue, when you multiply it across millions of transactions, it becomes very profitable.
So the customer gets cash back and no fees.
Mm.
And KOHO's profit is driven by the sheer volume of transactions.
Precisely. They also earn some interest on the cash that customers hold in their accounts, the float, as it's called. But the foundational strategy was always alignment. Give money back to the user and position yourself as a partner in their success, not their failure.
And when you look globally, you see this pattern everywhere with successful challenger banks.
You do. This model of fairness isn't totally unique, but KOHO's execution in the Canadian market was just perfect. I mean, look at Chime in the US.
Right, they basically declared war on overdraft fees.
And won massive market share because of it. Or look at TimeBank in South Africa, building its entire business on zero-fee accounts for people who were previously unbanked. KOHO fits right into that global mold.
That focus on simplicity brings us to the next big insight. KOHO knew that software alone doesn't change people's financial lives.
No.
Behavior does.
Behavior does. So they focus heavily on behavioral finance, using their app as more than just a tool for transactions. It was a mechanism for psychological intervention.
They absolutely engineered the experience to improve habits. This is way beyond just, digital bookkeeping. They introduced features like automated savings.
The set it and forget it idea.
Exactly. A small amount gets moved over after every paycheck, so you don't even have to think about it.
Yeah.
And then there's the roundup feature, saving the spare change from every purchase.
So my $4.20 coffee becomes a $5 debit, and that 80 cents goes straight into savings.
Yep. And their goals feature was more than just a tracker. It was a design intervention, using visual progress bars and notifications to really leverage that psychological need for feedback. It helps you stick to your targets.
It's the difference between just tracking spending and actively nudging it. And they also invested so much in the user experience, the UX.
Oh, massively. The interface was clean, modern. It was such a stark contrast to the clunky, intimidating portals from the big banks.
A frictionless journey was everything for them. Fast onboarding, you get a virtual card instantly, you see your spending in real time.
And that design-first approach, it just echoes other global successes. Look at Nubank in Brazil, using minimalist design to demystify banking for millions.
Hmm.
Or Monzo in the UK, using color and notifications to humanize finance.
Yeah.
That UX focus became KOHO's real differentiator in a country where banking just felt so bureaucratic.
Okay, so that raises a really important structural question. How did they manage to scale so quickly, offering regulated services without spending like a decade trying to get a full banking license?
They executed a masterful partner banking model. This is really the nuts and bolts of how you scale a fintech compliantly.
So they didn't go it alone.
No. They partnered early on with regulated companies like People's Trust. This meant KOHO could focus entirely on what they do best, the customer experience, the app, the innovation, while the partner bank handled all the heavy, regulated lifting.
Like insured deposits and compliance.
Insured deposits, settlement, full regulatory compliance, all of it.
But isn't relying on a partner a huge risk? Like a single point of failure? How do you stay agile if you're tied to legacy infrastructure?
That's the tension in the model, for sure. You have to manage the constraints. But that initial trade-off was absolutely worth it. They saw compliance not as a burden, but as a strategic asset. By partnering up, they instantly got the credibility and trust they needed.
We see this everywhere. The Apple Card is powered by Goldman Sachs on the back end.
Right, and Revolut, in its early days, relied heavily on partner banks all across Europe. It's a way to leapfrog that massive regulatory hurdle by just leveraging existing trusted infrastructure. It gets you to market faster and lowers your risk.
Okay, so KOHO's early success was all about being this great fee-free spending product. But then they made a really interesting pivot. They introduced a paid subscription service.
KOHO Premium, which later became KOHO Everything.
Yeah, why introduce fees even if they're voluntary after you've built your brand as the anti-fee champion?
It was a necessary evolution. I mean, the basic model funded by interchange. The margins are pretty thin, especially as you scale. A paid tier lets you shift from earning tiny amounts on transactions to earning a relationship fee. Users are willingly paying for genuinely better value.
So you move from being a utility to more of a service business, like a Netflix or Spotify. What value did they offer to justify that shift?
Well, the paid tier was packed. You got higher cashback rates, better budgeting tools. But the biggest differentiator, the thing that really drove that philosophical shift, was access to personalized, certified financial coaching.
The human element. That's fascinating because software and apps can only take you so far. At some point, you just need to talk to a person.
Absolutely. KOHO recognized that real financial empowerment is holistic. They gave subscribers direct access to certified financial coaches, bridging that gap between automated advice and a personalized strategy.
It's sort of democratizing financial guidance.
It is. In the U.S., you see platforms like SoFi doing similar things, integrating coaching into their loans and investments. It's an admission that people aren't just looking for an account. They're looking for a better financial life.
Let's pivot to a moment that really validated KOHO's entire model. Their partnership with the Government of Canada during the COVID-19 pandemic.
Yeah, this is a huge turning point. The government needed to get emergency funds out to millions of people fast, and they had a logistics problem.
How to get money to people who don't have traditional bank accounts or, rapid direct deposit.
And KOHO stepped up. Their infrastructure was built for speed, fast onboarding, immediate digital access. They could distribute those funds incredibly quickly and effectively. It really positioned them as a trusted public-private partner.
And this isn't just a Canadian story. We see this globally.
Oh, for sure. You think about how the Kenyan government used the M-Pesa mobile money network for relief funds, or how India used its UPI network for subsidies. When the old rails are too slow, these agile digital networks become essential infrastructure.
After the pandemic, KOHO kept expanding, but very deliberately. They focused on liquidity solutions designed to avoid debt traps.
Right. Things like their credit building program, which is made for Canadians with a thin credit file to help them systematically build up a score.
And the really big one, instant pay or earned wage access. How does that work, and what makes it different from, say, a predatory payday loan?
It's a game changer. Instant pay lets workers access a portion of the wages they have already earned before their official payday. It's not a loan.
So it's your own money, just earlier.
Exactly. Unlike a payday loan with its crazy interest rates, Instant Pay usually just has a small, flat fee. It provides that immediate liquidity for an unexpected expense without trapping you in a debt cycle. It's responsible innovation.
And that focus on responsibility seems core to their brand.
It is. What's so impressive is how they scaled while facing huge challenges. The big five banks finally woke up and started improving their apps. Regulatory scrutiny was increasing. But KOHO just prioritized structural integrity over, unchecked growth.
That's the difference between a sustainable company and a fintech flash in the pan.
Totally. We've seen so many global failures where growth at all costs just completely overwhelmed risk management. KOHO deliberately avoided that trap. And their core mission is still inclusion, helping younger workers, newcomers, low-income households, the people the legacy system often profited from.
They're reaching the underserved by speaking human, not compliance jargon.
Exactly. They position themselves as a partner, proving that trust can actually be a scalable business model, even in the toughest markets.
So when we step back, what does this all mean? The KOHO story really proves you don't need a traditional banking license or physical branches to fundamentally change how people interact with money. You need a clear mission, discipline, a clever way to handle regulation, and most of all, a product that addresses that real consumer hunger for fairness.
KOHO built loyalty by challenging the idea that banks have to profit from a customer's mistakes.
Hmm.
So given this global shift toward digital wallets and mobile-first finance, the question for you to really think about is this. If the future of banking relies more on engineered trust than on institutional size, which legacy financial behavior that you probably tolerate right now, maybe a hidden fee or a punitive charge, will be the next one to be seen as completely obsolete?